crisis, the new normal, understanding it, seeing past it. October 27, 2011, the advisors of Asante in the Manitoba region hosted a client event. This particular podcast is an excerpt from one of the guest speakers, Drumond Brodeur, who's a chief investment strategist with Signature Global Advisors, who manage approximately $34 billion of financial assets for Canadian retail investors and institutional clients as well. There's no denying that we live in a world full of political, social, economic, and market turbulence and change, and a lot of people hope for a time of greater constancy and tranquility in global affairs. However, a growing chorus of experts are suggesting that this environment of change and transition is, in fact, the new normal. We had asked Drummond to present to clients to give them some insights from his perspective on what's been going on with the major changes going on with the sovereign debt crisis in Europe, the debt and the deficit restructuring and major issues in the U.S., and how as portfolio managers they're positioning portfolios in the lead up to those crisis points, as well as their expectations around the investment opportunities that will be emerging as a result of this time of change and uncertainty. Drummond's perspective is interesting. He said, depending on which side of the fence you're sitting on, you're either extremely optimistic or you're increasingly cynical and pessimistic. So he's going to share some very interesting insights that we know would be very helpful to our clients to hear. So without any further ado, let's hear Drumond Brodeur.
When you hire an investment manager, when you want to partner with an investment manager, you have to give them the broadest, flexiblest mandate so that they can both protect capital and earn returns. And the way to do there's 4 key ways to add value and protect capital. It's through stock selection or security selection, it's through industry allocation, it's through asset allocation, and it's managing currencies. Okay? As an investment manager, you should be using all 4 of those buckets to protect capital and to add value. Okay? Very few do. Most do 1 or 2. We do all 4 of those issues. And in currency, if you think as you go global, if you don't manage the currency as Canadians, we found out that can hurt. So for flexibility in portfolio construction, if you buy into those 3 assumptions, you end up having to get a team that looks something like this. Okay, we have a team of 32 investment professionals today. It looks like this. At the top, you have the stock pickers, the sector specialists, portfolio managers who are looking at each of their sector. We have our fixed income who are looking at high yield, investment grade, and foreign exchange markets, the specialists in each of those. And then it's complemented by what we call the strategists, which includes myself and Eric. Our job is solely to sort of process all the information and to look at the top-down picture, try and understand the rules of the road. And what you see at Signature today, this business model we've built, we are probably the only truly integrated sort of cross-asset class global investment management team in the country. Okay, we are certainly the only one available in the retail space, and it's a business model that is sort of emulated by a number of the largest asset managers in the world, and more in Canada are trying to move in that direction. But as I say, it's taken us 10 years. It's not easy to develop. So we do have a slightly unique model. What I'm going to share with you now, and which helps explain some of the strong returns that we've delivered, I'm going to sort of now do my role in the model, which is to sort of give that big investment picture. I'm going to try and sort of run through what we're seeing going on in the world today. And I'm going to start out, this is basic our conclusions, our macro views. Because I found with these presentations, if I don't put my conclusions at the front, I never get to the end. Okay, so we'd never get to them. So I want to start with the conclusions, but even before I do that, I want to talk a bit about our position in the firm. Okay, because the most important thing to take away, we manage our asset allocation quite actively. It's a significant value adder for us. So we will shift into the markets, into cash, equities, to bonds, etc. In our positioning in the past year, as we were fully invested coming into the year, we started raising cash in April of this year for a number of reasons, some of which I'll touch on as we go through the presentation. We took our cash levels up from April through to the beginning of July to roughly 20%. If you look at our cash and our gold weight, our funds had 20 to 25% cash and gold by the middle of July. So we were quite defensively positioned. We knew there was going to be a lot of volatility, because for a whole number of reasons, one of the tsunami in Japan shutting down the auto industry, and the quantitative easing too, and those were the reasons we started raising capital. And then in early July, and when we were speaking to a number of policymakers and advisors in Europe, we understood that Europeans still didn't get it. We'll talk a bit about that in a minute. But those led us to get very defensively positioned before we came into that sell-off in August. We kept that defensive position, called 20% cash, right through August and right through September. Okay, as of the first week of July, we put that money back to work. We went from 20% cash down to 5%. Ladies, that's a shopping spree of almost $2 billion, just to put that in perspective. So when we go shopping, we really go shopping. Okay? But what I want you to take from that was that we're not that pessimistic. We are not that bearish. Okay? We have put the money back into the market because there's a tremendous investment opportunities out there. And the reason it's important to take that away is because from here on in, everything we're going to talk about is going to be pretty scary. Okay? It's Halloween. It's time to have some scary stuff going on. There's a lot of challenges in the world today. And it's the challenges in the world today doesn't mean you have to sort of run and hide underneath the desk. It means you have to try and understand those challenges, understand what the new normal environment is, and understand where the investment opportunities are. Okay? Because they are out there. It's just when you're in a zero-rate environment, it is tougher. Okay? So if you look at then in terms of our overall macro views, basic global rebalancing is the new normal, and we're going to talk a bit about what global rebalancing means. But it really means we are going to be in this two-speed economy. The developed world is stuck in a slow growth environment. The global economy continues to be led by the emerging markets. Okay? You have to understand what's going on in the emerging markets part of the world. Okay? And we'll talk a bit more about that going forward. But it's absolutely critical. They've been driving the global economy for quite some time already. Understanding of that dynamic is only slowly sinking in to the broader investment world and to the broader communities. Even our own government only belatedly started to understand the importance of China in recent years after spending several years trying to poke sticks into their eyes, which was not necessarily very conducive. So the new normal, it is a two-speed economy. It's driven by deleveraging in the West, emerging markets driving the global economy. But it also means globalization is we're all in this together. This is not like the Cold War period where it was the U.S. against Russia. And if you pulverized your opponent, you won. That was good. This is the opposite. This is an interconnected world where what happens in any one part of the world affects every other. So if the U.S. really pounds up on China, puts on trade barriers, tries to cut them out of the business, China turns around and they start selling the U.S. bonds because they own more U.S. treasuries than anyone else in the world, and they collapse the U.S. infrastructure, and everybody goes down in flames. Okay? We need to figure out solutions together. And people get that. That is why the G20 meetings, and we're going to have another G20 meeting coming up in France or Paris on November 3rd. That is why the G20 is so important. It's a forum to try and get the important global actors together to at least make sure a dialogue is taking place on what potential solutions there are. Because we have to figure it out together, and we all have a vested interest in doing so. We have to watch out for things like financial repression, capital controls, protectionism. Those are some of the political threats that could come up that we're looking out for and watching out for. Okay, because that can affect your financial health. Okay, so those are things we're very aware of and we talk to a lot of people on, because the reality today, politics matters. Okay, most of my career we spent right through the 80s and 90s saying politics don't matter, just look at the fundamentals. Okay, one of the things that changed is that today politics matters as well. So do the fundamentals, but you need to have the ability to also understand the political issue. So 2011, 2012, where are we today? And if that's the bigger picture up top, where is the shorter term picture? We're still in an environment where the cyclical trumps the structural. Yes, there's a lot of structural challenges, but there's also a cyclical element right now. And we see that cyclical growth taking place in the economy continuing to roll out. So if we look at year 3, certainly in the U.S., we see no evidence that conditions necessary for a recession are in place in the U.S. Okay, so we still see continued growth in the U.S. It is a slow growth environment. Trend growth in the U.S. is 2% because of the deleveraging. As you're trying to pay off the debt, that is a drag on overall growth, and that means that you're going to be in this 2% trend growth rate. Okay, as the economy fluctuates around that, every time you go a little below that, all the bears are yelling, oh my God, we're in a bear market again, it's a double dip recession. We saw that all through the summer. Is this one working now, or am I... no, I think I'm still working off this one. Getting itchy, I'm trying to walk around. If your mic works, it's easier for me to walk around and talk. So the preconditions, I say, for a U.S. recession are not in place. What you need for a recession, a business cycle recession. This one working? I got that? All right. Stick it in the pocket. Okay, we'll try and see if this... Can you hear me now? All right. Feels like I've been freed from prison here. We can walk around. Okay, so the preconditions of a U.S. recession. If you look at a business cycle recession, usually what happens is the upswing of a business cycle, you sort of accumulate a lot more inventory, you hire more people, you build more capacity, to the point you end up getting way too much excess capacity, way too many people, you get fat. So when the downturn comes and things slow, you start slashing away at that fat and reducing it. And that's what we were in 2007, 2008. There was an economic business cycle recession taking place that got overwhelmed by the sort of the credit crisis. But you had that sort of original business cycle dynamic taking place. Today, you don't have that. We never recovered from that last recession. That CEO of Schneider Electric that I referred to, he said, we had our business in 2008, our business collapsed. He said, since then, 40% of our business, and we adjusted. We cut people, we closed facilities, we shrunk down. He said, 40% of my business never came back. That business that deals with broadly the developed world, the US and Europe, never came back. He said, you can't kill that twice. So if we could have a slowdown now, I have nothing to cut. And that dynamic means you're not going to get the sort of wave of sort of cutting back on CapEx and laying off people. He said, my orders are strong. I said, I'm seeing no signs of slowdown in my business and my order book anywhere, but I'm looking at what's going on, and this is in sort of early September. I'm reading the paper, and I'm getting concerned. So just to be on the safe side, I've put a freeze on hiring and discretionary spending. Okay? That's how sentiment can be translated into a real downturn. But he says, I have nowhere to cut. I'm in hiring mode. Okay, so those preconditions do not exist. It's growth. It's going to be slow growth. The reason we see a recession in Europe, the same issue, there's no preconditions for a recession in Europe, but the dynamics that have taken place in Europe over the course of the past 3 months meant that you've seen funding channels shutting down in Europe. Companies are losing access to capital. Banks cannot fund anymore in Europe. Sovereigns cannot fund in Europe. So they're the banks are having to sort of squeeze their asset base, reduce lending, put up lending costs. And so although the companies generally don't have any need to cut back, they're losing access to capital to be able to fund their growth. And that will cause, at the very least, we think, a shallow recession in Europe. Okay, but a shallow recession in Europe is not the end of the world. Europe's been stagnant for a decade. Shallow recession, as long as they're dealing with the issues, are not going to be a problem. So generally, we're still going to have an economic recovery in the West. It's going to be a slow growth. As I said, politics determines market outcome. We need a sense of crisis to get politicians to act. I refer to it as the CRIC cycle. C-R-I-C. Okay, this was a framework that was developed by Robbie Feldman in Japan in the 1990s to sort of look at where you get into this sort of post-credit crisis environment of political action determining the outlook of the economy. And it's basically you get a crisis, you get a response from the policymakers, which then leads to an improvement. And as soon as you get an improvement, you get complacency, so you stop the reform process, which brings us right back to a crisis again. Okay, that is the environment, one of the best frameworks to think of what's going on in Europe and increasingly in the US. Okay, because a lot of what has to be done is hard political decisions and structural reform, and if you don't force politicians to do it, if you don't hold their toes to the fire, they're going to back off from it. Okay, and that's why market crises, shutting down of financial markets and access to funding, I think is going to be with us periodically over the coming sort of 5 to 10 years. That increased volatility will be with us, which means it might be a little scarier to invest in some of these markets, but ultimately it doesn't mean they're not good return opportunities. Okay, so the political crisis is important. As a result of that sort of fiscal debate contraction that has to take place, monetary policy, interest rates are staying loose everywhere in the world. Okay, those monetary taps will have to stay on. We're in a liquidity trap, so they don't have a whole lot of impact, but they're certainly not going to be tightening. That's the backdrop. The investment implications that we get in is that in this environment, where you want to invest is essentially strong and growing balance sheets. You want to avoid sort of over-leveraged, shrinking balance sheets. And broadly speaking, in the world today, where you have strong balance sheets, where you want to be investing is in the corporate sector, because the corporations, large companies, large multinational companies, did not participate in this big leverage boom that took place in the U.S. That was households, mortgages, housing, and the banks. The corporations have pristine balance sheets. Record levels, over $2 trillion of cash in U.S. companies' balance sheets. Record high cash flows. So the corporates that you're investing in terms of equities have some of the strongest balance sheets in the world, some of their strongest balance sheets that they've ever had historically. And I, for one, am more comfortable lending to an awful lot of corporate balance sheets than to a lot of sovereign balance sheets, which is what you're doing when you're buying government bonds. So corporates are strong growing balance sheets, and the emerging market consumer. Those are two big segments you want to have exposure to. The second way, the shrinking balance sheets, government balance sheets are over-levered. Okay, they've either had too much debt from the buildup, or as in the case of the U.S., they've absorbed the debt from the banking and housing system. They now have to pay down, reduce that debt. They have to shrink their balance sheets. Investing in shrinking entities is generally not does not lead to a great outcome. And developed market consumer. The consumer in Europe and consumer in the U.S. are not overly affluent at this moment. They're not feeling very flush. It's not going to be a great place to be investing. So generally, those are where, from a big picture, where you want to be getting your exposure and what you want to be avoiding. Overall, government bond bull market is over. If you start government bonds at 18%, as we did in the 1980, and you bring them down to zero, you can't go much further. You're sort of there. It's done. You can bounce along the bottom. Now, I've been saying this for a year now that it's over, and I've been wrong so far this year because, with financial repression, this issue up here, which is what you can call what the U.S. Fed has done in terms of their quantitative easing and their Operation Twist they just operated, which was there to take the 30-year down, from that 3.5% range down to 3%, the 10-year down to 2%. So they're pushing it down as far as they can, but it's a zero bound. You're playing for that very last little bit that you can get in that bond market. At some point in time, that's not the fact you're going to lose money in bond market. In reality, government bond interest rates at this level pose all sorts of problems. It's a world of pain for any insurance companies, any pension funds, anyone with long duration liabilities, with actuarial requirements and I had this conversation recently with an insurance company. They're saying, we have a problem. We have a 6% actuarial requirement. We have to earn 6% on our assets over time just to meet our liabilities. If I invest in bonds today, the supposedly risk-free asset, if I invest in bonds today, I guarantee that I fail, that I cannot meet my liabilities. That's not risk-free. Part of the problem in the industry is we define risk the wrong way, but that's a whole other discussion. But it creates all sorts of problems when you have that bond, the interest rates at very low levels. You have to look elsewhere for yields and returns, and understanding where those opportunities are is something that Signature specializes in and works to do. Real assets remain attractive. Property, infrastructure, commodities, a lot of things that cannot be monetized away that do benefit if they're going to start running the printing presses. And the third issue is de-equitization, which I'll come to at the end. I have a slide on that, but it's just the fact if you look at asset prices today, if you look at equities that are trading basically on 10 times earnings with a 4 to 5% dividend yield, it makes sense for corporate treasurers today to issue bonds. You can issue bonds at, multinational companies, AAA companies, at a 3% rate or a 4% rate. If you can issue bonds with a after-tax cost of debt that's below your dividend yield, you can buy back your stock in a self-financing way. The more stock you buy back, the more cash you have left. This doesn't make any sense. Okay? And ultimately, that means that you're going to see companies issue more and more debt and buy back stock, whether they're buying back their own or buying other companies through M&A. And you're seeing that playing out slowly. And it's that dynamic is a big reason why we are not Japan. The U.S. is not Japan. That capitalist impulse, very important in, I think will correct in some of the problems that Japan never had, which we can't go into too much detail. Okay, so moving along, I want to give you a couple of frameworks to sort of think of what that new normal means, what the world is really doing, what we're in, and the environment we're going to be in for the course of the next 5 to 10 years. Because if you have that sort of big picture framework, it makes some of the smaller moves and changes easier to understand. In the first frame, of the economic perspective that we're in, what global rebalancing means from an economic perspective is that surplus, you have a number of surplus countries and a number of deficit countries. In this case, in terms of this diagram, the U.S. is a massive deficit country. It runs a huge current account deficit. So as a country, it spends more than it actually makes. So it has to borrow money from the rest of the world, which is reflected in the current account deficit. The flip side of it, by and large, is in China, which runs a huge current account surplus. Okay, so China has too many savers, they're saving too much money, and they're lending all that money to the Americans to spend. Okay, I started out from an academic perspective taking economic development a long time ago. But I'm pretty sure the economic development models were not that the poor country is supposed to lend to the rich country. Okay, that really wasn't the way it was sort of set up. That's not how the World Bank and the rest really thought they were going to help the rest of the world. But that's what we've gotten into today. Rebalancing means you have to sort of correct some of those imbalances. The significant level of excess of current account surpluses that have built up and current account deficits have to readjust. Okay, and you have to readjust by shifting your competitiveness. Okay, you can think of the same sort of issue in terms of, when I'm talking about US and China, Europe itself is a microcosm of this. Europe as a whole is basically imbalanced. The periphery countries are in a huge deficit. Germany in the core is the surplus countries. So they have a similar rebalance that has to take place, which is the longer term challenge in Europe. But at the end of the day, you have to get more competitiveness. Currency changes the old way it used to adjust. Fully floating exchange rates could do it. We don't have that luxury anymore today. In Europe, because they don't have their own currencies. And here in the US, China's going to adjust their currency at a slow pace, but their underlying economy can only absorb so much of a currency change year to year. Okay, and this degree of the competitiveness spread is just way too high. What it means is that to get more competitive, wages and asset prices in the US are going to have to fall and continue to fall relative to what's happening in China. And what that translates is to, we're going to have a decade of falling standards of living in the US and rising standards of living in EM. Okay, because this I use US and China, they're the two biggest ones. You add the rest of the emerging market countries, it just enhances the story, same on the developed side. But thinking inside of that, it's rising standards of living in China, falling in the US. And okay, that's what part of the new normal is. Now, this isn't all that new. This has been going on for at least a decade now. Okay, if you go back and if you look at the median household income in the US, the median household income in the US has been flat now for 12 years. Okay, the US income have already been stagnant for over a decade. But while their incomes were stagnating for the past decade, the good thing was in the US, you didn't have to let your standard of living fall. Because you embarked on the biggest leverage boom of all time. So even though you weren't earning any more money on average, the fact is you were borrowing a lot more money. So you could buy a bigger house, you could buy more toys, another car, etc. And they did. Okay, so you had this biggest leverage boom in the US as you had stagnant wages and prices. And today, part of the sort of the new normal is that deleveraging. Now that the financial crisis really marked the end of banks willing to lend or that trade continuing to go on, it means now you're back to the new normal of a stagnant income, okay, plus a massive debt overhang. So it's just going to be that much more painful than it would have been had a decade ago they made some of the tough decisions. Okay, that's part of the reality the U.S. is going to be facing. It means the world that paid the middle class in the U.S. is slowly being evaporated. Okay, as their wages get eroded away, particularly on a relative basis. The opposite is true in Asia. In China, real wages have been rising for double-digit levels every year for over a decade. This year in China, minimum wages were up by 20% year over year. Part of it was catch-up from the past when they were a little bit slower, but on average, you've been getting a real wage increase of roughly 10% each and every year since you've been working. Now, by a show of hands, everyone in this room has made 10% more each and every year for the past 20 years. Raise your hands. Is my mic not working? Nobody heard the question? Okay. I can tell you, I can tell you by empirical observing, because I also have not had that same increase. But if you live in a world for 20 years, your income goes up by 10% each and every year, you have a very different view of what the world looks like today. That breeds a lot of optimism. And that's why the rise in wage and assets is leading to extremely strong consumption and rising rates in the emerging markets. That's why the emerging markets, that's why China is the most important consumption story on the planet today, and has been a much bigger consumption story driving the global economy for the past several years than the US has already. Even though, and if we're doing questions, I get someone say, yeah, but isn't the US consumer the only big consumer in the world? We've got to dispel this myth today. That's one of those things you have to take away, that change, and we'll come back to it. So that is that global rebalancing. This takes years to accomplish. Okay? You cannot just crash a system overnight. This adjustment is going to play out over the course of the next 5 years. And what, as I say, it means is just a more slower, stagnant growth in the US and continuing strong, albeit slowing growth over in China. That's the economic framework that we're living in. The rebalancing is taking place from a pure economic perspective. You have to understand also the political construct behind it. What's happening in terms of the political environment. Because we've led over the past 30 years in terms of environment. The Washington Consensus really took over. This U.S. sort of belief in sort of deregulation, free trade, that the markets are all self-correcting. Any deregulation, lower taxes, less government is always a good thing. And that's really been driving a lot of, the environment or the world we've been operating in the past 30 years. It's coincided with globalization, dismantling of trade barriers. It's been a tremendous boon to the overall global economy. It has been extremely positive, but it went clearly way too far. Okay, when you certainly within the financial markets, as you started taking trade to excesses, you had NAFTA, the development of the euro, Glass-Steagall was the removing of the barriers between investment banking and deposit-taking banks in China. The Asian-Latin crisis was in many cases a warning shot. Okay, that was within Asia a credit crisis and the correction of the imbalances within their economies. Asia learned the lessons of imbalances at that point in time a decade ago. The IMF rode into Asia to help them solve those problems. Draconian medicine, they were forced to rebalance pretty well overnight. Okay, and that's why Asia has ever since been outperforming from an investment perspective now for over a decade. And the lessons learned in the Asia crisis, and the reason there's no debt by and large in Asia today, because of that, those lessons are what we're going to have to learn in the West in the coming decade. Okay, so there's a lot that we can learn from Asia in terms of the way behaviors change and patterns of change that took place. But we continued to drive this sort of globalization, deregulation, really right up to the financial crisis. Okay, that did mark a change. And that financial crisis and economic crisis that we've had means we're going into an environment today where you are going to have significantly more intervention. You're going to have a lot more re-regulation, a lot more government involvement in the world today. And look, I'm all for free markets. They do operate. They do work. They are better than any other system that is out there. But any free market system needs to have a regulator. You need regulation, and so the Greenspan idea in the U.S. that they're all self-regulating, you got to call BS on that. It didn't work, and it led to the problem. And so re-regulation to a certain degree is definitely a positive, okay, but it does change the way the world works. The rules are changing. Okay, and you have to understand that change of the rules of the game. If you do not adapt to the change of the rules in any given industry, you're going to die. This is Darwinism at its best. Okay, so understanding how those changes, how that re-regulation, how that new nationalist agendas are going to play out, it's leading us right into what I'm going to call, we are on the cusp of much more social and a political crisis. Okay, what we're seeing going on in the U.S. with the Tea Party movement, with the Occupy Wall Street, with the protests that we're seeing, this is not a problem in itself. This is a symptom of the underlying problems. This is a symptom of that erosion of the middle class that's taken place. A symptom of the fact that incomes in the middle class have been stagnant essentially for the past decade. Okay? The pain of that adjustment process is going to be reflected in a lot more social instability going forward as we have to change how the world works. In the financial industry, the Dodd-Frank bill is a clear example of that. They are re-regulating the financial industry. That's why banks are screaming. Okay, that's why we're getting a showdown between Jamie Dimon and our central banker, Mark Carney, who, with Jamie Dimon screaming, you can't put all these regulations on us, you're going to kill the banks. And the central bankers and the politicians are saying, we're not going to kill the banks, but you're right, they're going to be a lot less profitable. Okay, the Dodd-Frank Act still requires about 400 new regulations to be written between now and Christmas. That will require roughly 25,000 pages of legal laws to be written between now and Christmas. It's not going to happen. That's pretty clear. But those laws are coming anyway, even if they take longer to get there. It's going to dramatically reshape the way the financial industry works. A lot less capital, a lot less profitable, a lot of businesses that got us into trouble in the past are going to disappear, and many of those are going to be a good thing. There will be a lot of unintended consequences. Some of those unintended consequences you've seen in Europe today, where forcing recapitalizations on the bank means the banks are saying, okay, I'll shrink my balance sheet, stop lending to corporates, which causes problems in the economy. As I say, funding channels drying up. So the interconnectedness will create some risk in the wobbles, but the reality is that is where we're going to. It's that reality is that Zimbabwe has never defaulted on any Zimbabwe debt. But no one will buy Zimbabwe debt. They'll only buy it if they issue it in US dollars because of the misuse of the printing press. Okay, so the problem in Europe, therefore, is Italy, which is issuing too much debt, cannot access the printing press because the ECB, they do not control the ECB. Now, the ECB in August, when the spreads in Europe started to sort of blow out, the ECB struck a deal with Italy that says if you start putting more fiscal measures in place, we will start buying your debt to stabilize the market. Okay, so we'll, on condition that you do the right thing, we'll step in and stabilize you. Which Germans were furious against, the ECB is not supposed to do that. But the ECB did that. Within 36 hours, Berlusconi turned around and flipped the bird to the ECB. I know I said I was going to increase taxes, I was change this, I'm going to do that. And in 36 hours, he said, we've sort of changed our mind. Maybe we won't do it quite so hard or raise this or do that. He backed off. ECB was absolutely furious. And the problem is, the ECB, well, they have the ability, the printing press, they're the only institution big enough to actually backstop the European sovereign debt issue. But they do not legally have the right to force conditionality on a sovereign elected state. So the ECB was stuck. They had already committed to supporting them, putting their money behind their bonds, and they couldn't force the conditionality. Okay, the EFSF, which has been created, can enforce conditionality. If Italy had applied to the EFSF, they could put a program together that they have to sort of follow. But the EFSF does not have the balance sheet to sort of backstop Italy, so that you don't get any confidence that they can do the problem. So the fundamental challenge in Europe today is that you have the institution that has the ability to force conditionality, force politicians to take the tough changes, does not have the size and balance sheet to do it. The institution, the ECB, which has the balance sheet and the size to do it, cannot enforce conditionality. And that's why people have been working all over the place to find conditions. How can we sidestep these problems in a way that doesn't require treaty change, that we go back, because the ECB cannot, no country is allowed to bail out another country. The ECB is not allowed to bail out another country. They can provide stability. So there's all sorts of legal problems to dealing with it. That's what shot the Eurobond down issue earlier, is that wouldn't get by the German Constitutional Court. Okay, so they have to reconcile that issue. The proposal that came out today is an insurance wrapper, that the EFSF will take their $250 billion, leverage it up 4 or 5 times in an insurance scheme. For all sorts of reasons, I think that's a step in the definite right direction, because you're dealing with the real problem. It probably won't work. If it does, great. If it restores confidence in funding channels, fantastic. We solve the financial crisis in Europe. If it doesn't, in 3 months' time, we're no worse off, because the ECB is still going to step in. Every time the ECB has been faced with a choice of either you step in across what you're comfortable doing or you let the euro fail, they've stepped in and they will continue to do so. Okay, so at the end of the day, I think you have to get a mechanism backstopped by the ECB. I think it's going to take many years to get there. And it will take these continued crises, and slowly you're going to see Europe inching towards greater fiscal coordination. Okay? They know what has to be done. Jean-Claude Juncker said, he's the Prime Minister of Luxembourg, I believe it is. He said, the politicians in Europe, we all know what has to be done. We just don't know how we're going to get re-elected after we've done it. Okay? And that is really sums up what's happening in Europe, and it sums up what's happening in the US. Okay? And we've had discussions. I met about 3 weeks ago with an ex-Democratic congressman. He was a 6-time congressman. He's still very involved. Eric met 2 weeks ago with an ex-Republican senator, also still very involved in the whole process. And we're hearing the same story from both sides of the aisle in the U.S. Okay, U.S. politicians, policymakers know what has to be done. It's an election year. They have no interest in cooperating and getting it done. Okay, so if we move on to the U.S., so if Europe, to put Europe to bed, they're dealing with it, they're moving forward. That's what we saw today, the announcement. It stepped in the very much right direction. We'll get further details as we go forward. Markets were so positioned to be negative. That's one reason we went in. They understand the problem today, but the structural adjustments that take place will take probably 5 years. The Maastricht Treaty took 10 the last time they had to make broad constitutional changes. So it will be a long, slow process. As long as they keep funding channels open, okay, the economy will continue to perform. On the U.S. side, as I say, it's the same issue. It's all about politics. In the short term, the economy is going to do okay. As I say, we expect it to be that 2.5% growth. We saw that number come out this morning, the 2.5% growth rate. It put the bears in a spin because all they've been arguing, look, this growth, we saw very slow first half growth, and it's going into the double dip recession. The reason it was such slow growth in the first half, or certainly the second quarter, was you had two things driving that. The tsunami in Japan, which caused the shutdown of the U.S. Auto industry. So the Japanese assembly plants in North America cut production by 50% within 5 weeks, laying off people. That's one of the reasons we knew we were going to get a lot of weakness over the course of the summer. Secondly, you had the high oil prices in the first quarter of this year, which acts as a huge tax on the consumer. The consensus in spring of this year was that the U.S. economy was going to weaken in the middle and bounce back in the second half. We agreed. We still agree. We've never wavered from that. As the weak data came through that everyone expected, everyone shifted. Oh, well, look how weak the data is. We're going to have a double-dip recession. Okay, all the papers in the media, and stop reading the papers, please, guys. It's not good for your financial health. It really isn't. They are it's bad news sells today, so they don't want to call up someone who has a bullish outlook on the world and put their story in the paper. No one's going to believe it. Get me someone who's more bearish than the last guy. And they're falling over themselves these days to be more bearish. The world's challenging. It's not as bad as it looks, as they make it out to be. So on the U.S. side of it, we very much see that slow growth continuing as they delever. The fiscal debate that's taking place, what happened in August of this year, was an absolute circus. It was a complete sham. It should never have been allowed to happen. It did lead to a bit of a repricing of risk and concern, because that's when I think a lot of people realize that politics does matter. Okay, that politicians, usually we can ignore politicians, but now we need our politicians, and people realize the quality of politicians they had elected. Okay, and that was a little depressing. So that has led to a bit of repricing of some of the risk, but it doesn't mean, as I say, it is the end of the world. Where I could potentially be wrong in the U.S., where I will be wrong in the U.S. sometime in the next 2 years, the housing market in the U.S. is key. But at some point in the next 2 years, the housing market is going to be a huge boost to the U.S. economy. If you look at a housing crisis, it normally takes about 7 years to flush out. The housing market in the U.S. peaked in 2006, collapsed down to the bottom in the beginning of 2009, end of 2008, and has been going sideways ever since. So if you look at from a new housing starts, and you can pick any of the housing metrics you want, from a new housing starts, you basically went from a 20-year average of 1.5 million new houses a year, you went up to a peak of about 2 million a year, okay, just before the collapse in 2006. And then you've collapsed down by 2009 to about 500,000 to 600,000 new starts a year. Okay? This is way below. Even if you went to half the long 20-year average, 750,000, it's almost a 50% pickup in U.S. housing construction starts. Okay? At some point in time, that inventory is going to be cleared, because the U.S. continues to need, their population growth, household formation is about 1% a year. Okay, so the need for those houses is growing, it is there, and it will at some point start being a driver of the economy. It's actually been contributing for the past year, not subtracting, but at a very low level. That is the only way you're going to get any sort of job growth in the U.S. is when the housing, because a lot of the unemployment is structural. My 2% scenario growth in the U.S. means structurally high unemployment's not going away. That ties in to the eroding middle class issue. Okay, where I'll be wrong is if we start to see that housing market pick up, and like the guy at Schneider said, once you've killed it, you can't kill it again. Okay, so you cannot get the housing market in the U.S. to be the drag again that it used to be. Okay, the politics in in the U.S. Very important. If you look going forward, November 3rd, we have the G20 meeting in France. We'll probably get more detail that's taking place in Europe, more flushing out of some of the programs that were announced today. So we're still going to be focusing on Europe. Markets today can only focus on one thing. I think studies show that men can only ever think about one thing at a time. Okay, women, you guys can multitask, so you're better off than us. Okay, but the males in the market, we can only focus on one thing at a time. We obviously need more women in this industry to look at multiple things. So right now, we're looking at Europe and getting scared. Okay, November 4th, after that G20 meeting, it's going to be okay. They seem to be fixing Europe. What's next? And they're going to focus squarely on the U.S. because on November 23rd in the U.S., that's when the U.S., the 12 apostles, that's what I call them, they got to come with their deficit reduction program. This was the committee that was set up in August. That debt debate, they came up with $1.5 trillion of cuts back then, and they appointed the 12 apostles, 6 Republicans, 6 Democrats, get together November 23rd. You have to come with a package for at least another $1.5 trillion of cuts to the deficit over 10 years, and it then goes to the House for yay or nay vote, up or down. No changes. You either accept it or you don't. Okay, now those 12 apostles are working away. They're very bipartisan groups, so the ability, I was pretty skeptical initially about their ability to work together, just because you would put a lot of people on there who were going to toe the party line. A lot of what we're hearing now is that they actually are working on trying to put something pretty credible together. You got a blueprint. You go back to the Simpson-Bowles Commission that was charged a year ago with coming up with a debt reduction plan. That was a very sound policy that was put in place. As soon as it hit the table, both parties disowned it. Okay, the same thing is likely to happen here. One reason I'm optimistic that it's going to come out is so far all the other politicians not on the committee are complaining that they're being very secretive. They're not sharing what they're looking at and talking about, and that's bad. It's bad because the rest of the politicians can't get their sort of hooks into it and try and tear it apart before it even comes out. Okay, and it means they're actually trying to do something. I suspect, however, they'll come up with a very solid proposal, and then by December 23rd, when the vote has to happen, it'll get voted down. So the focus is going to be back on the U.S. fiscal deficit, which is multiple times bigger and worse than what the situation is in Europe. So we're going to get a little bit more volatility in the market. But the good thing is, the default, if they don't deliver, the default is that $1.2 trillion of cuts you get anyway, starting in 2013. So if you're looking from a fiscal responsibility point of view, the default is a win regardless. The reality is this is all part of the 2012 election campaign, and whoever wins that after that, they're going to have to set a much more credible fiscal package going forward. But the fact is that debate is joined. At the beginning of this year, I would say one of the biggest concerns in the U.S. is they were not addressing the fiscal debate. That is no longer the case. Today, we now already have $1 trillion plus in cuts, plus another $1 trillion two guaranteed for 2013. So way ahead of the fiscal debate in the U.S. than what we would have expected at the beginning of this year. The reality in terms of the fiscal debate in the U.S., Republicans say no tax raises. The Democrats say no cuts. It's not possible, guys. The U.S. is all about tax reform and entitlement reform. If you look at taxes, if you look at the basically the 60-year average, essentially the government takes in about 20%, or takes in about 18% of GDP in revenues, and it spends about 20% of GDP and leaving a 2% deficit. That's been the average for about 60 years. Where we are today is we've had spending ballooned out above 25%, but the tax take is about as low as it has ever been in 60 years. You have a massive debt and deficit problem, and your tax levels or rate is the lowest it's been in 60 years, and below average doesn't make sense. Okay, reality is spending's got to come down, taxes have to go up. That spending coming down has to happen, and this is the spending rate is before the retiring baby boomer entitlement bomb goes off. As you approach 2020, the healthcare spending and entitlement spending in the U.S. gets completely and radically out of control. So it's not just tax reform in the U.S., it's entitlement reform. Okay, and that's part of the new political reality, the social unrest we're going to see, is that we, over the course of the next decade, are going to start unraveling the social welfare states we've built up in the West. They are not affordable. Canada is not immune to that discussion either. We're in far better shape, if nothing else, because the Canadian pension plan, a decade ago decided to start pre-funding that instead of just out of general revenues. But a lot of the entitlements that have been promised do not make sense. So, and healthcare being the biggest one, the longer we live, the more healthcare we consume. So that will be part of the debate going forward. Now, I'm getting signals I'm running out of time, so I have to talk in terms of why the emerging markets are important. It's about the rising middle class in Asia. And I'm going to go through this really quickly because I really have gone over time. You have to understand the importance of China. Okay, and it is a middle class consumer. I'm not going to talk about that one. Just very quickly, this is looking at the number of households with disposable income over $10,000. Okay, the consuming class. Okay, the U.S. has been roughly at 100 million households at that level, basically a sort of pretty slow, steady trend growth rate, and going to continue there. The reason you hear so much about China over the past sort of decade is because about almost a decade ago is when China hit the inflection point where they went exponential in the number of people having disposable income, the number of households entering the consumer society, the consumer world. Okay, and they've been growing. The number of households with a disposable income over 10,000 is growing at an exponential rate. This thing here, 2012. Okay, by these numbers, in 2012, China will have more households than the U.S. with a disposable income over $10,000. Okay, that's why China is the most important consumer story on the planet. That is why just about every multinational company we talk to is reorienting their business to take advantage of the growth opportunities that are in China. That's why they're moving operations over. They're not moving operations over there for low-cost assembly to ship back here. They're moving high-end jobs over there to supply the economy. The consumer society in Japan is about to take off, and it's been driven by the fact that China today is becoming a white-collar society. If you look at this just in terms of the size of the China economy, China today is already, everyone knows it's the largest consumer of resources in the world. We all know that. How many people know that 47% of the global wine auction business today goes to China? This is the high-end wines in Bordeaux. Almost 50% of the global high-end wine is being bought in China today. This isn't about people in rice paddies anymore, guys. Luxury good markets beyond that, almost 50%, 45% of the global luxury market today is in China. China is the largest market in the world for mobile phones. It is for gaming. These numbers understate that. It is the largest beer market in the world, tobacco market. It is the largest auto market in the world. It is far larger than the U.S. in terms of the number of automobiles produced and sold. It is a consumer economy. At the same thing, computer market. But look at these areas, sort of insurance, sort of pharmaceuticals, software. There's a number of areas that consumption has not yet taken off. The growth opportunities are tremendous over there. I don't have time to talk about this. The good news in the U.S., we're more prone to deflation than inflation. There will be no inflation in the West. That's the good news. It means interest rates won't go up. The bad news is everything you buy every day is going to cost more. If I had more time, I would explain why that is the case. From now, you're going to just have to accept it. Sorry. And this is the reason for optimism, the de-equitization. If you look at the market today, if you want to invest your money today, you have to look at the market and say, what are the choices I have today? Where can I put my money? You can put it under the mattress and earn nothing. You can lend it to the government and earn close to nothing. Okay, so lending to the government, 2.76% return for government treasuries. You could lend it to corporates. Corporate bonds on average, quality corporate bonds are at sort of about 5.2%. So you can get a 5% return lending to sort of quality companies. Okay, or you can invest in sort of large cap companies and an earning yield of 9.7%. Okay, so those are your options today. Those are the choices. I didn't make that up. As you can see, the dispersion here is at record highs. We've never seen anything like this over the course of the past 30 years. Okay? Equities are extremely cheap in the marketplace. As I say, your dividend yields are higher than your government bond yields. Your government bond yields are negative in real sense out past the 30-year mark at this point in time. Okay, so there are tremendous opportunities out there. There is risk involved. You have to manage risk. Ultimately, at Signature, that's what we are. We are risk managers, and we sort of look to partner with our investors in terms of solving your investment needs. Sorry to be way over time, guys.
That's okay.
I'm going to blame it on the mic problem. It took me hours to fix that. Thank you, guys. Thank you for your patience.
Thank you.
That concludes the presentation that was delivered by Drumond Brodeur, Chief Investment Strategist with Signature Global Advisors. It was a real privilege for the advisors in the Manitoba region to host this client event, and by the feedback we received, clients really enjoyed the insights offered by Drummond throughout that presentation. If you have questions or would like to talk further about the presentation or meet with your advisor, don't hesitate to call the Asante Advisors at area code 204-942-1169.